Today's Animal Spirits is brought to you by Index Coop. I'm looking at the DeFi Pulse Index right now. This is the DeFi Index, as you know, it's a DeFi Pulse Index. It's up 28% this week.
I think one of the interesting things about crypto is they tend to all go up and down together, but you're starting to see like some correlation differences. Bifurcation, is that the word I'm looking for? Where you're seeing some differences in performance especially from Bitcoin and even Ethereum in some cases, where you're seeing these massive gains or losses. And I think that's a good thing for this space in the long term. So
some of the names in this index that's on chain is Uni, Aave. What's LRC? Don't know that one. Maker, Sushi. And these things are insanely volatile, to state the obvious, right? No pain, no gain. But yeah, they're on fire. And Bitcoin's not on fire. Ethereum's not on fire.
Yeah, and this thing, to be fair, DeFi had a really tough few months there when the other stuff was ripping. So it is interesting to see. And we were looking this morning at just some of like the 7-day gains in these things.
Ridiculous.
And massive gains. It's
so
crazy.
one thing that we'll link to in the show notes is Bitwise did a really good like 101 explainer on DeFi. And my favorite analogy that I pulled out of that report, I forget who said this, was someone described DeFi as self-driving banks, which I think is an analogy that, clicks with most people. So visit indexcoop.com to learn more. Ben, I don't know about you, but I was cooped up at home for the last week. One of my boys' teacher was exposed. I mean, I feel like everybody knows somebody if they're not exposed themselves or positive themselves. So we were home last week and this felt like a 9-day weekend to me. I was thinking like, when was I last at work? But technically the market was closed on Friday. Friday was a day off, I guess. So it was a 3-day weekend that felt like a 9-day weekend.
You've seen the cartoon before where it's like a young person coming to work after the weekend and they're all sad. And then the other one shows parent with little kids coming to work and they're like joyous and happy. Right? Yeah, I guess. Yeah, for sure it was a 4 or 5 day weekend for most people. You had the COVID thing. We've had some things too where we've had classrooms closed and teachers and people. I mean, so I guess the report from someplace was like 3 billion people could get this. That's like they're modeling it out. I don't know if that's accurate or whatever, but they're saying like if the current trajectory holds and whatever, even if it's not that many, like this is not an original thought at all, but this has to prolong the supply chain / labor market shortage stuff, right?
The supply chain and labor market shortage.
Well, think about, so like over the
I don't
weekend,
know about labor market, probably supply chain, but people are going back to work.
Well, I'm saying it's going to be harder to get people because other people are sick, so it's going to just continue to cause disruption. So think about the airlines this weekend. They were showing people flying back to and fro from holiday travel plans, and
to and fro
like that. But they were showing that airline crews, pilots, and flight attendants couldn't make it to the job because they were exposed or they had COVID.
Actually, a friend of mine was supposed to go to the Dominican Republic. Flight was canceled because they couldn't fill the plane with workers.
Right. So,
but I saw an interesting chart that the number of TSA like checkpoints was at an all-time high despite all of the disruption. People are saying like, I'm going. You're not stopping.
Oh, right.
I'm going.
Yes. There's certainly an element of that. I just think like at certain points of your life, especially if you have kids, you're going to get disrupted regardless. But I feel like these last 2 waves have cost us our roaring 20s. Right? We had like a roaring 20s for like 3 months. Didn't it feel like it after like everyone got their vaccine?
I'm still long the roaring 20s.
Okay. So I looked at this like early on in the pandemic. I think I wrote this, let's see, March 25th. So this is like right in the heart of the pandemic. I said, what happened to get to, yeah, I wrote this like early on. And so like World War I went right into the Spanish flu of like 1918 to 1919. There was a recession in 1919, then a depression in 2021. And then finally, after all that crap that people had to go through, you had the roaring 20s. So maybe it's going to be here, it's going to take a little longer to get there. But I feel like we were robbed of the roaring 20s by Delta and Omicron.
I disagree. I think they laid the groundwork. Maybe not the variants, but I think that one of the reasons why we're going to have a roaring 20s is because of the pandemic.
That's possible.
Wasn't that what we're talking about here? This shook things up so to such a degree that so many people left their job to start new businesses.
Yeah. Okay. So you're saying it's just on the back burner. I hope so.
I'm saying no change.
Okay. I do think that, yeah, there's going to be a really great book written someday about all the businesses that grew out of the ash of this pandemic. I think you're right there.
So strong holiday sales. What happened to the supply chain issues? So there was an article in the Journal talking about how companies got ahead of this. FedEx, UPS, their delivery rates are like 95% or something like that, which got me thinking about Castaway.
Okay.
Right?
Also,
well, because remember in Castaway, Tom Hanks with the clock, with the stopwatch.
Yeah. So you're saying that that stuff was overblown and that people buying 2 months early probably actually helped things, or who knows?
Yes. So all right, U.S. retail sales rose 8.5% year over year, compared with 2019, because that should be the baseline, up 10.7% retail sales. So there's holiday sales, obviously, right? We're talking about Christmas,
so
Hanukkah,
what's the stuff?
Whatever else people celebrate.
What's sitting on all those container ships then?
That's what I was thinking. Well, I guess durable goods. Nobody's giving a washing machine for Christmas.
Ah, that's true. So it's the big stuff probably.
That's sitting on the containers? Yeah, I would think so. So, all right. So here's the deal. Sales at physical stores rose 8.1% year over year, 2.4% compared with 2019. E-commerce. Remember how much we thought e-commerce had penetrated to the ecosystem? I don't know why I'm calling it ecosystem. The universe 2 years ago. E-commerce sales are up 61% compared with 2019.
So, by the way, you mentioned the physical store thing. I think I'm just never going back to a physical store to shop ever again. I mean, stopping for things at like the liquor store or the grocery store, but actually shopping in like a mall, I don't think that I'm ever going to do that again in my lifetime. I had to take something back recently.
How awful was it to like go to the rack and like do this?
And you can never
move
find your
the clothes,
size. Like immediately
hold up the clothes to your. Does this fit?
Yes. Now you can just order anything, and if it doesn't fit, you send it back, and they send you something right away.
I was shopping this weekend on Instagram, and I saw something that made no sense. It really sort of blew my mind. It was a New Balance fleece hoodie, short sleeves.
That's for Bill Belichick.
In what weather is that appropriate for? So it's like for the dad that wants to look fashionable but also be freezing.
Oh, by the way,
in the cold weather.
This is where finance bros get it all wrong. A vest, although it looks kind of cool, is the most useless article of clothing there is.
Makes no sense. So I was thinking about this. The only way to wear that in a way that makes even a little bit of sense is if you have like a thermal underneath it.
Right. Yeah. That's just, you're trying to make a fashion statement when you wear something like that.
Or are you wearing it in the hot weather and just sweating your butt off? I don't get it.
There's like 48 hours out of the year where you could wear that and it makes sense. Right?
All right. Nate Garassi had a good stat. The S&P 500 has hit a record high 68 times this year. Second most ever to 1995. Wow. The index is up nearly 28% year to date. So he said, who called this at the beginning of the year? Good reminder as 2022 predictions start coming out.
Not only that, I looked today. So if it holds, unless we get like a crash in the last 3 days of the year or whatever, 5.1% is the biggest drawdown peak to trough for the S&P this year. Out of the last 94 years, that's the 9th lowest drawdown we've ever had. So you not only had a 30% gain almost, you had zero volatility basically.
And I have to point out that we're actually hitting an all-time high today on Monday as we record. So it's now the 69th.
Don't say it.
It's now
Don't say it.
I'm just giving the data. It's
right.
The 69th all-time high this year.
So we're up almost 30% this year. Last year was 18%. 2019, we were up 31%.
Oh, speak for yourself. Speak for yourself. When you say we, you're talking about the S&P 500.
Sorry, S&P 500.
I'm not up 30% this year.
S&P. Your index funds are. 2018 was a down 4% year, but then 2017 was up 22%. So 2018 is the outlier. But if you take that out, this looks like the late 90s almost. So you had 95 through 99 was up 37, up 23, up 33, up 28, up 21. Obviously, the total return there is way more because you have the down year in 2018, and that sort of cancels it out. But it's not that much different.
This is breaking my brain. Think about how bearish people were. Forget about 2017, yes. Like 2013, right? Yes. And so again, 2017 to today, plus 21, minus 4, plus 31, plus 18, plus 29. LOL.
Right? Yes, I know everyone keeps saying, I've seen this movie before, it'll end badly, but we're on year 13 of this now.
I just got to say, shout out to the S&P 500 community. It's so welcoming. Such a great community.
Yes, they should make it a DAO. It would do even better.
It turns out, Ben, that SPACs stink, especially ones that are backed by celebrities. Bloomberg had an article showing that 21 out of 33 SPACs tied to famous public figures have posted a negative return for 2021. And this quote killed me. Not counting the SPAC tied to former President Donald Trump, which minted a phenomenal gain of more than 400%. The rest of the group averaged an 11% drop through December 13th, with rapper Jay-Z's 84% plunge.
Ooh, that's the soccer coach gif.
The worst of the bunch. Isn't there like isn't there a Jay-Z cringe gif? I feel like there is.
Oh yeah,
right?
But this looks like it could have been taken right from the script of Don't Look Up. Right? Yeah. We'll get to that later, but I can't believe that Shaq didn't come through with a better return. How did Shaq's SPAC do?
I don't know, but it turns out that even despite
wait, what did Jay-Z's SPAC invest in? Did they just not invest in anything?
No, down 84%. They had to pull
how many
something.
Does this? I didn't read this article. Do they have anything about how many of these have started? Like how many SPACs have just had the shareholders gotten their money back yet, or can they not do it yet?
Let's see. It was.
Isn't that the deal where you can vote to get your money back eventually?
Those are that's the pipe money, the insiders.
Okay. Oh, okay.
And yeah, a lot of them are pulling out for obvious reasons. It was a cannabis company. Okay. So anyway, and yet, Ben, there's still money waiting to go into these SPACs. There's way too much money sloshing around. The Journal had an article. SPACs raised about $12 billion in October and November, doubling their clip from the previous 3 months. So there was a frenzy. You see the monthly amount raised by SPACs. There was a frenzy in February and March, cooled off, and now we're going again. We're going.
At least people are learning their lesson. So we got that going for us.
But it's not just SPACs, it's everything. So the cash committed to venture capital firms and private equity firms is also ballooning. So-called dry powder hit about $440 billion for VCs and roughly $310 billion for growth-focused PE firms.
See, this is back to your Roaring 20s piece, that any idea right now is going to have the longest runway in history. Like entrepreneurs now are in such a great spot where they can raise money at the drop of a hat right now from anyone. They're beating people off with sticks to raise money, and they can stay private for as long as they want and have all the money that they need to try their idea out for as long as they can.
The idea that we've given, or the example that we're used to prove this point, is Dapper Labs. You might not like Top Shot or NFTs or whatever and say this is so dumb it's going to zero. Yeah, guess what? They raised $600 million or whatever the number is. They're going to be around for a while.
Yes.
Get used
By
to
the way, I don't know why, they sent me an email saying, hey, we sent you $30. I don't know. Does that count as like an airdrop, like a token kind of?
I don't know, but here's what I'll say.
All I know is they sent me $30, so I'm whole on my Dapper Labs balance now.
There you go. It's not just celebrity-backed SPACs that are stinking. Obviously, the entire complex stinks. Of the nearly 200 companies that have gone public through SPAC deals this year, 75% are below the listing price. Nearly 40 companies have gotten cut in half. So this is an interesting. Paradox is not the right word, but an interesting juxtaposition. That's the word I'm looking for.
Especially since we just talked about the stock market doing so well this year, and these are getting crushed.
What's amazing is that private markets, I don't know if this is always the case, are much more forgiving than public markets. Once these things have no problem getting liquidity, raising money from private investors. Once these things go public, if they don't deliver, good night. Short
leash.
So isn't that interesting? I don't know if that's always the case, but private markets are the real arena.
Isn't this best case scenario though? If you're just a normal stock market investor, the speculative bullshit just gets taken out. The stock market doesn't care, just does fine, right? Like that's perfect for regular 401k average Joe investor.
Not that we certainly did not predict this at all, but I feel like we've spoken about this. What if these names get taken to the woodshed and the market doesn't blink? That's what happened.
And this is the problem if you're someone who's bearish all the time.
Well, because a lot of people thought that once the bubbles in these names pop, it'll bring the rest of the market down. So wrong.
Right. All right. We're sticking with good news here. This is from Barron's. The U.S. economy is just a machine. So this said, when the COVID-ravaged economy contracted in 2020, it was just the 19th time since 1920 in which real gross domestic product had declined year over year. And 9 out of those times came between the years of 1930 and 1949 as a result of the Great Depression or post-World War II. So basically, 10 times, if you take away Great Depression and the war, the U.S. economy has contracted year over year.
So wait, hold on, pause. People have a lot of beef with capitalism, and it's certainly far from perfect, but come on.
So listen to this.
It's pretty good.
GDP was $670 billion in 1920. Now, by 2020, it was $21 trillion. I think it's $23 trillion now. 30-fold increase, meaning U.S. GDP has grown about 10 times as fast as population, which has tripled from 106 million people in 1920 to 330 million people a century later.
What about inflation adjusted? Shadow stats adjusted.
It's real GDP. I'm just saying that maybe this is like ring the bell, top is here. Do we just spend way too much time worrying about worst case scenarios? Like, yes, sometimes there's a good reason, but people have worried for the last 10 years about hyperinflation and retiring into a Great Depression and government debt and rising rates. Even the pandemic was barely a blip on the markets and the economy came roaring back immediately. Like, do we all just spend our time worrying about stuff that could happen 0.1% of the time, and the other 99% of the time, or 99.9% of the time, everything works out fine?
Yes, but here's my but. I think there is good reason for investors to focus on the downside, but do they do it to their detriment? Do we focus too much time on the downside?
That's what I mean.
Of course we do, but bear markets really suck, and they are so devastating that I think it does make sense to at least put yourself in a position always to survive one, because when they come and they stick around, they just destroy portfolios and investor psyche for years. So for example, Ben, in 2009, and again, this is like, I don't know if 2009 is worst case. It could be the worst recession that we see in our lifetimes. I'm not saying it's going to be, but it could be, right? That was a pretty bad one. Like financial system on the brink, like that was pretty bad.
There's a good chance.
So 2009 took the stock market back to where it was in 1996.
Right. Price basis?
So
Okay.
To 1996. So bear markets like wipe out
I do remember
years and potentially decades of bull market returns.
I do remember
that's why I think investors tend to pay a lot of attention to them.
So the biggest worry was, so I guess you could say worry about the risk and the return will take care of itself. So I remember,
but not if you worry too much. Not if you worry too much about the risk.
Yeah, as long as your brain doesn't get broken. So like coming out of the crisis the last time, people were worried like I'm going to retire and there's going to be a double dip recession and I'm screwed. Right. So I for some reason this piece has always stuck out to me. Michael Kitces wrote this in 2019. He wrote about the extraordinary upside of sequence of return risk. So people worry about sequence of return risk on the downside. Like if you retire and you retire into a bear market and you're selling, you're screwed. Right. So the idea is, of course, don't have all your money in stocks, and especially when you retire. So you have to have some other sort of dry powder in bonds or cash or something else to take the money out of, so you're not selling when stocks are down. But he said after a 4% withdrawal rate, and he's looking at a 60-40 portfolio, the odds of nearly depleting a portfolio are equal to the odds of growing it by more than 800% historically. And he said that like looking at the 4% rule got you to your initial balance to make it through 30 years of retirement on every occasion. Like that was like your worst case. So he said that on average, a 4% withdrawal rate on average results in retirees finishing with nearly triple the amount of their original principal, on top of sustaining a withdrawal rate of 4% adjusted annually for inflation. Obviously, people say, well, it's different this time because rates are lower. The thing is, we talk about this with our clients that like you have to, at times, prepare for like, what if things are better than I expected? And what am I actually going to do now? Because that sounds like, oh, great problem to have. The world's tiniest violin, this person with money made even more money than they thought they would. But like, that's hard for some people to deal with, right? Like things actually went better than because think about if you're a boomer and you've retired in the last 10 years. Stocks go up every year. Your house is up phenomenally. If you own your house, you have all this money sitting there. You're probably in a better position than you ever thought possible 10 years ago financially. And so now what? What do you do? That's like, again, an easier problem to have than the alternative. But for some people, it's still not easy to deal with. Like, what do I do when things go better than I thought they would?
It's hard to keep these two ideas in your brain that you need to like put your portfolio in a position to survive the upside. But also, what if your portfolio is literally cut in half in the next 2 years, because that risk is always on the table, and you have to like not overreact to that risk, which is ever present, and it's hard.
Yeah, part of the risk part of your portfolio for sure.
Right.
This is why so much money is going into bonds, because people know this now. They know they need to have another piece of their portfolio, regardless of inflation and what happens to rates. That piece is going to be there for me to take if stocks get crushed.
Right. Right. So yeah. People ask like, well, what upside do bonds have with a negative real yield? All right, fine. You want your entire portfolio in stocks that can fall 10% in a day?
Exactly. This is why people own bonds.
And Bored Apes. U.S. savings rate. This is a wacky chart. Fell to the lowest level since December 2017. So obviously we saw the spike due to fiscal policy and all that sort of stuff, people staying home. And now it's down to 6.9%.
I'm sticking with my theory that this is good for the labor market shortage.
Well, yes.
All the excess savings people had is being spent.
So now I'm saying like this chart is probably evidence of people returning back to work.
And this is probably also good for supply chains, right? Because there's not going to be as much demand anymore. A lot of the demand came because people were so flush with cash, right? Mm-hmm. So I think working down some of these savings, and that happened. This chart looks like the unemployment rate almost. It spiked and then came way back down immediately, right?
Yeah. What was that double dip spike? Oh, was that the second round of stimulus?
The second. Yes, you can see where the stimulus hit for sure. I'd like to make an analogy. This is like a blog post on a podcast. I was doing some reading. I think this was actually a Barry Ritholtz recommendation. He gives us recommendations once in a while on Slack. And he said, read the end of average. And so there was this study of fighter pilots, and they wanted to determine how fighter planes had changed from like starting out in the teens and 20s to the 1950s or World War II, saying like the guys sitting in the cockpit don't fit anymore. They need to totally redo it, and they wanted someone to study it. So they studied like 4,000 pilots.
Wait, why don't they fit? There was like people size inflation?
They thought like the way that they were making them, and people were getting bigger, and they said, we need to make this more comfortable for people. And so they took all 4,000 of these pilots in the Navy, and this guy studied them, and he took the average arm length and leg length and all that, like figure out, okay, this is our average pilot out of these 4,000 people, and this is how we're going to make the cockpit. And when they took the average of those 4,000 people, then they actually compared it to the actual dimensions of these Navy fighter pilots. Not a single one of them was within an average range of all 10 dimensions that they were studying.
Oh.
So they took an average, they found it, and they realized there wasn't one person who actually was that average. My analogy here, this is the inflation rate, right? We have this inflation rate at 6.1% over the last 12 months. I was thinking about stuff we've spent money on. So we got a new car lease that was up higher. Daycare was up 10% this year or something. That's ridiculous. But something like gas doesn't factor in as much as it used to because my office is like 5 minutes away. I remember when my wife and I did a long distance relationship right out of college. She went back to school. I took a job on the other side of the state. The only price I ever paid attention to was gas. And I remember in 2008 it spiked. And that was like my whole budget back then is gas. Now I don't care about it anymore.
Gas was over $4, right?
It went really high, and right at the time when I'm driving, like every single weekend back and forth, or one of us does. So my point is that like this is how inflation works, because no one is that average inflation rate. It's way lower for some people, way higher for other people. Few people are actually at that average. That's what I'm getting at here.
Good point. You know what's this was interesting to me. It's not just inflation is like a global phenomenon. And we're seeing, there was a few things that caught my eye this week. Somebody tweeted Spain's producer price inflation rose to an all-time high, 33% year over year. Holy shit.
Okay.
And there was an article in the Times that inflation is soaring in Europe.
So you know who's been really right about this from the start is a guy who always gets beat on for just saying the same thing over and over again. Jeremy Siegel has been calling for higher inflation pretty much since the start of the pandemic when we spent all the money. Right?
Love that guy.
He's like the stocks for the long run guy that everyone always says, oh, he's just a perma bull. He kind of called this. He said, we're going to get...
First of all, not true. He wrote a well-documented article literally in 1999 towards the top that tech stocks are super expensive.
But I remember he said, if we're going to get higher inflation and it's going to be like 15 to 20% in aggregate over 2 to 3 years. Now that still may not come true, but he's been kind of on the forefront of this. He was right.
There was a quote in this article that stood out to me that we all know to be true. People are being more careful about their consumption. Nobody is really expecting prices to go back down, end quote, because they don't go back down. Used car prices will come back down, but by and large,
this is the psychology behind inflation, right? And how does it impact consumer, how they think about stuff? Because it changes the way you think about the future. So if you think prices, I guess it's a difference between will prices fall versus will prices continue to rise in the future. Because if you think prices are going to continue to rise, then you buy more now.
Buy today, right?
Right.
Buy now, pay later. Wisdom Tree had this chart. Speaking of Siegel, since 1950, so we've been talking about what, like, people say, what's the best way to hedge inflation? Well, it's not a 1-for-1 hedge against inflation, but over the long term, stocks. Since 1957, dividends have grown by an average of 5.7% per year, more than 2% above the average rate of inflation. This chart is pretty much up only. There's a few periods where it plateaus. It dipped in 2009 because all the financial stocks cut their dividends, but dividends grow.
People always ask us, what's the best way to produce income in a portfolio? Own stocks. Because the the income grows over time. Even if like the yield seems paltry and it's like, well, it's 1.8% or whatever. The stock market is up 500% over the past, since 2008, 2009. The dividend yield has stayed relatively constant that time because the dividends themselves keep going up. Mm-hmm. Stocks have the most impressive dividend stream. All right, here's another inflation piece. People have too much damn stuff.
Speak for yourself.
This is in the Wall Street Journal that like self-storage is so hot right now in the pandemic, and people are paying more than ever to stash their stuff. And they show this, there's this chart that shows storage space and like net operating income has just exploded in all these public storage and extra storage space. And I guess you could make the argument, well, some of this is people who live in big cities and they don't have as much room, but people just have too much stuff.
Was that an intentional Zoolander joke?
What did I say?
So hot right now.
So. Oh, yeah, it was. Right, but like if you get to the point where you're not living in a studio apartment and you need to have a storage facility and there's not a really good reason for it, like you're moving or something, isn't that like a cue to you that you have too much stuff?
Well, a lot of people live in apartments for ants.
I guess so. But yes, this is
in
my
New York
solution
City,
to inflation.
Everybody in New York City in a studio apartment has a storage space. You have to.
Okay. And I guess if you are like running a crime syndicate on the side, you have to have one too. Every single show about crime, they have a storage space, right? With something in it.
Best storage space of all time? Breaking Bad.
Easily. Yeah. Yes.
All right, I want to spend a second on some Web3 stuff. By the way, a lot of beef between Web 2 and Web 3. Did not see that plot coming to fruition in 2021.
On Twitter, I think it's kind of fun to watch, to be honest.
So Legion and Katie Parrott wrote a post called the Web3 Renaissance, a Golden Age for Content. And I understand why people's knee-jerk reaction that don't spend as much time on this as we do is like, this is all bullshit. I am totally sympathetic to it, but I think this will maybe help shine a light on why we see the potential here. So they wrote, and I'm going to read this for a second. In 100 True Fans, I described that creators could tap into fans' self-interest to monetize at higher price points. By delivering substantial value and results, creators could more effectively monetize and make a living from fewer fans. This represents a move away from the traditional donation model in which users pay to benefit the creator to a value model in which users are willing to pay more for something that benefits themselves. Web3 takes this idea to the next level because all tokens are investments that not only fund the creator, but also can benefit the holder if the value appreciates. Jesse Walden defines Patronage Plus as patronage with the possibility of profit, a phenomenon that was introduced through tokenized ownership. That investment element was an impossibility in Web 2 without an on-chain record of ownership like an NFT or a social token. I think, end quote. I think the point of this like really truly cannot be understated or overstated. I'm sorry.
The one thing that like your initial traditional finance brain says is, well, why do you need the token if someone can just start a Substack and do this on their own? But I've seen so many Substack people that have 9 months later said, I thought I was going to have X number of subscribers and I'd make X amount of money, and it did work. So now I'm going back to traditional media. And the token thing, like the one thing, this is why I'm surprised that Charlie Munger has never said, you know what, these crypto guys haven't figured out, because the one thing that crypto has figured out better than almost anyone in the past 10 years is incentives drive everything. Right? This is what Munger has built his like belief system on, is incentives drive everything. That's why they have these yields in DeFi, and why this money pours in, because it's all incentivized, right? People wouldn't do the Bitcoin mining thing if they weren't incentivized by earning Bitcoin. So that's the one thing crypto's figured out, is that you have to incentivize people to do something.
And prior to this, there was no internet money. And here's a great example. So there was an airdrop on Christmas Eve. You might have seen this from this company called OpenDAO that did an airdrop to people that have done transactions, that have bought NFTs on OpenSea. And so based on the number of ETH that you spent, they had a formula smart contract that dropped SOS, which is a token, onto its users. And I was speaking to my friend Eric Golden about this, like, where the hell does this money come from? It's like money that just literally gets created out of thin air. So why doesn't everybody just sell it immediately and just dump the value to zero, right? Like, why doesn't everyone just redeem and just dump it to zero? Well, that does happen in a lot of situations, but in cases like this, there is a secondary market to basically make the market for this thing. So some of the automated market makers, Uniswap, whatever, they start doing these pairs, SOS, ETH, there's buyers and sellers. And now I was checking, there was $170 million worth of tokens, SOS tokens, traded in the last 24 hours.
So they create a token out of thin air, and then it's put on the marketplace, and the market decides the price.
Yes, it's an IPO for users, basically. And there's incentives between the financiers, which is sort of the beef between Web 2, Web 3, the people that created the DAO. And so we were talking, like, people are talking about, well, why doesn't Twitter do this? What if Spotify does this, where they reward people by listening, by how many minutes that you listen to a podcast, right?
If I was paid every time my 4-year-old listens to Baby Shark, she'd be going to college already.
You know what's hilarious?
I
saw this out of the corner of my eye yesterday. I have like a Baby Shark. There was a box and it said Unishark do. Literally Unishark do. And I was like, does that say Unishark DAO?
No.
Anyway, the reason why this can't happen is because there is no internet money for Twitter. If Twitter tried to do an airdrop to all of its Twitter users, how the hell would it happen? All that they have is your email address. There's no Twitter wallets. There's no way to get money, Twitter tokens, to its users. How would they even do this?
So this is why they need crypto, basically.
This is where tokens, crypto comes into place.
I do think that having said that, like, crypto figured out incentives, I do think as these projects are rolled out, it'll be really fascinating to see how those incentives have unintended consequences. Where something is really hot for like 3 months, and then someone comes along and has better incentives, and all the users leave. So like, it'll really be determined how much of community is there really versus how much people are just trying to get rich. And there's going to be a little bit of both, obviously.
100%. And there's going to be a ton of garbage. And I saw some people dunking on this. I saw this tweet, Blockbuster DAO.
I saw that too.
So our mission is to liberate Blockbuster and form a DAO to collectively govern the brand as we turn Blockbuster into the first ever D-film streaming platform and a mainstay of both Web3. I mean, come on. Do we need this? Why buy Blockbuster? I mean, come on.
Nostalgia sells, I guess, is the hope there.
Which
is the same reason why they had a Matrix 4, right? The only reason that movie came out is because of nostalgia.
And we'll talk about this. Honestly, I haven't read the thread, but this sounds so dumb it just might work. Why not? All right. Well,
wasn't that investing in 2020? This sounds like a stupid idea. I better put more money in.
I bought non-fungible Olive Garden last night. It's the dumbest thing I've ever seen. It's got to work.
What?
Exactly. Kathy Wood last week, we spoke about her saying that Ark could generate 40% returns. So Jeffrey Patak did the work and here's the data.
That's like me in 5th grade saying I could play in the NBA. I could. All right.
All right. There was 10. So this is a study from 1991 to today. There were 10,538 funds that had at least one 5-year return from then to now. Of those, 146% earned a 40% annualized return over a 5-year period. But since then, there was 1.4 million 5-year returns reportedly by all 10,538 funds. So this means that this feat that she's described happened 0.1% of the time. And you could guess when it happened. .com bubble. Yeah. I think there was a biotech bubble in here. So it could happen.
It's thematic funds, which hers is. So it's a thematic fund.
I
so
think
like
the problem
maybe,
is, I feel like she just did 40% a year for 5 years.
Right. I looked it up, actually. Even with her recent drawdowns, it's like 25% a year, but still.
That's it? I mean, that's not that's
high,
it.
yes.
My point is, okay, fine. My reaction was, she's done better than anyone in recent memory, and
she's
it's
already done phenomenal.
Air quotes, only 25%. How in the world could she do 40% going forward?
I bet I'd have to run the numbers. I bet Buffett has like 2 or 3 40% per year runs in like the 70s
Probably in the
and
50s.
80s. In the 80s, I'll bet he did. But still.
Yeah, I bet you didn't. 40?
He had a good run in like the early to mid 80s. I did a piece on this one, so I'll have to look it up. But he had some pretty phenomenal returns.
All right, so Doomberg put me onto, that's a Substack that I've read a bunch. It's basically clever, funny, zero hedge. Planet for the Apes. He alerted me to this. This is the lead. This is an actual lead in the Wall Street Journal. They did a deep expose. Did I use that word properly?
Wait a minute. I'm going to go back to this real quick. So through the peak in February 2021, Ark did 37% per year annualized.
That's pretty good.
Since inception.
And that's got to be about as good as it gets, no?
Yeah, so she's saying effectively I could almost do this again after the run up they already had. That's asking a lot.
Okay, so all right, here's the lead in the Wall Street Journal article. A mob rescued the world's largest movie theater chain from the edge of bankruptcy. It turned out to be only the first act in an improbable story that made this year in American business like none other. More than 4 million people joined forces to put billions of dollars into AMC Entertainment Holdings, staking their money on a company so battered by the pandemic and competition from streaming entertainment that Wall Street investors had bet big on its imminent collapse.
I can't believe it was that many people. So we talked about this earlier. I was saying like every behavioral book you ever read talks about the herd mentality and how it eventually leads people to lose their minds. And every investment mania has this happen. But usually this stuff happens and then it goes away, right? So this stuff happened. It peaked in like February, January this year was like huge, which feels like a long time. Remember we did that stock market contest in January? That feels like 13 years ago.
Wow.
It was this year. So, and we did it at the perfect time when all this stuff was going on. But you thought it would fall, and it hasn't. And we came up with this term, credit to us, like community mentality now, where these people have stayed into it.
What term, credit to us?
We turned herd mentality into community mentality.
Oh, okay.
And it's like, it's gone on longer than anyone could have possibly imagined. I mean, these stocks are down 50% from their highs right now, but AMC is still up like 1,200% on the year. It went from a $475 million market cap company at the beginning of the year to like 11 or 12 billion now.
Absolutely.
And these people
wild.
are staying in it.
And there's this is no disrespect. There's no way that this company, the equity of this company is worth $12 billion. It's just zero in no world, but in this world. And guess what? This is the world that we live in. So here's a quote that I want to read. Sometimes, this is just from one of the community members or one of the owners of the stock. Sometimes it's not about what the fundamentals are. It's who the other shareholders are. It was clear there was a group mentality around this effort. That has fundamentally changed the nature of markets. And I think that the old days of like short sellers being so vocal about their shorts, you can't do that anymore. These people will steamroll you. It's insane.
Right.
And I don't hate it.
It's again, just the fact that it's gone on for as long as it has. We kind of all figured like, okay, that was fun while it happened. You had this craze. There'll be some books written about it. But then it's still kind of going on, even though these stocks have gotten crushed. They haven't gotten crushed nearly as much as they went up.
No way. And now some people obviously take it way too far. There's people that have like their identities tied up with AMC, and they're on YouTube spewing like all sorts of conspiracy theories about the actual number of shares outstanding and all sorts of stuff.
It's very bizarre.
It's bizarre. But this idea of community investing has really flipped everything that we thought we knew on its head. And it's not going away.
Right. Yes, I can't imagine being a hedge fund manager and trying to step in the way of this. All right, we've gotten a lot of questions from people over the years, especially this year, about like, when do I know when to get out of a growth stock? Like, a growth stock's getting killed. When do I get out? You always talk about just having price discipline. I'm more of a fundamental kind of guy, so I wanted to use an example. So I'm not like a growth stock investor by any means, but like in my Robinhood account, I dabble. And so after the CEO of Stitch Fix was on Patrick O'Shaughnessy's podcast in 2020, like I thought the idea sounded amazing. And I bought shares and the stock was up like 100%. and then it got crushed. And they announced that she was stepping down. She was like the founder and the CEO. She was stepping down from the firm. And I think at that point I was still up a little bit. I was still up like 15 or 20%. And I said, you know what? I could hold on, turn around. But I'm like, no, I sold immediately when she got out because she was the whole reason that I bought in the first place. And it's gotten crushed even worse since I sold. So I definitely was there for a decent part of the carnage. Luckily, I bought it early enough where it didn't matter that much to me. But that's like my thesis had changed. And that's how I saw it. And actually, like it worked out because the company has probably fallen 50% or so more since I sold. I did some Peter Lynch channel checks on this. I became a customer. I used it. And so her whole thing to Patrick was like, we get more data points about people's clothing sizing and all this stuff. We're going to create an algorithm that just gets you the perfect size clothing. And so I tried this out, and every 2 or 3 months, I get a box of stuff from Stitch Fix. And I've used it for probably the last year. And they ask you what you want. And what I found was that their algorithm is bullcrap. It doesn't work. Like you pick, I like this, I don't like this, and you go through and you answer all these questions. What works is actually telling a stylist, this is what I want. So like you still need the human, like an algorithm could not predict what kind of clothes I would like.
This is very similar to like iBuying. This is like iShopping. It's
hard.
Yes,
it's hard. So that's what I realized, like, oh wait, this doesn't scale at all. You need someone to talk to, and I would say, I want this specifically, and I want it to fit like this.
I can be a stylist. What do you need? T-shirts? You need T-shirts?
Anything from Instagram.
Any graphic tees?
But yes, I thought like this could be huge and Amazon will buy them. Then I thought like, oh, wait a minute. This actually doesn't scale at all. This is like being a financial advisor, like being a personal stylist. You cannot style someone on their clothes based on an algorithm. You need a person. And it's like human interaction. That was the only way that I could get clothes that I liked. And now that I do, it's kind of fun. It's like Christmas where I get to open up new presents every 3 months.
Yeah, investing is hard, not just in growth stocks, but particularly in growth stocks that tend to have these wild, dramatic swings up and down. You really need to like come up with some sort of plan ahead of time. And just because you have come up with a plan doesn't mean it's like a good plan, but like it's better than nothing. If you're just purely doing this on emotion, you're toast.
Yes, exactly. Yes, about when to get out and am I going to hold this forever or is this a trade or whatever.
Right. So you have to define what you're trying to do before you buy a growth stock. So it turns out that people really don't use their Alexa. And if it wasn't for my kids playing Baby Shark, I don't use my Alexa. Do you?
We bring up the average on this for sure. We use it all the time.
For what?
Music.
Okay.
Music.
Okay.
But my kids will ask Alexa, how do you say yellow in Spanish? Because they learn Spanish in their little school. So we use it way more than other people, but it's only because we have kids. If we didn't have kids, I would use it marginally.
Okay. So according to internal data, there have been years where 15 to 25% of the new Alexa users were no longer active in the second week of the device. That doesn't surprise me. This blew my mind. Amazon employs more than 10,000 people to work on Alexa. And the documents that they study projected its fixed cost to be $4.2 billion in 2021.
So don't you think that means it's going to get better eventually? They're
I would
trying.
say that makes me think that I am significantly underutilizing its capabilities.
Well, I think part of it is, so do you get the notifications that say like, hey, looks like you're all out of toilet paper. Mm-mm. You should probably order some.
No.
See, we have those. Okay, I got to turn those off because those annoy me more than anything. But we use it like almost as like a talking Google. My kids will ask questions to it and then they play music, and that's really the only way we use it.
I just don't love talking to a machine. Maybe I thought that maybe I was in the minority, but it turns out that I'm not alone.
Well, for some reason, whenever my wife tries to talk to it to get it to do something, it like doesn't listen to her well. It only it's like a dog where like I'm the master and it listens to me, but not her. It's very bizarre.
All right. It turns out, Ben, last week we spoke about like crowdfunding movies, and I threw out the idea of a DAO. It doesn't have to be a DAO, just the idea of like crowdfunding movies, like how everything is fractionalized. I suspected that I would like to finance a movie. Like, right? This sounds like fun. It turns out, holy shit, that's actually happening. So the FT had an article. Francis Ford Coppola's son is launching a platform called Decentralized Pictures to, quote, democratize the financing process and open the doors to new talents. So the platform will give investors and other potential contributors the chance to vote on which films should be produced. Non-investors can also join in by earning voting rights, for example, by volunteering to be script readers. That reminds me very much of Index Coop and how some Index Coop participants get tokens.
My first thought of this is, I don't know if you were ever a Simpsons watcher, but when they let Homer design a car, his stepbrother, whoever it was, ran a car company, and Homer designed like the worst car in the world, and it lost him all their money, and the company went under.
Could be.
Like you're gonna get some awful movies.
Oh, for sure. But decentralized is still under development. Plans to be up and running in the first quarter of next year. Has raised $7 million. Its income coming from donations and the sale of its digital tokens, Ben, called film credits.
Not a bad idea.
They're not the only one. There's one in Canada called Token Funder. There's one called Block Film. So there you have it.
Let's say so that their goal is to democratize the financing process and open the doors to new talent. You are a fintech company, and I say in your first press release, you cannot use the word democratize.
Shut it down.
I'm out. Sorry.
Socialize.
All right.
All right. Let's do one listener question. With Ben Carlson.
By the way, we had a new listener mailbag on the last show on Monday, so if you missed that, check it out.
Good plug. With Ben Carlson, excuse me, the Fed announcing plans to raise interest rates 3 times in 2022. Savage. Is now the best time to purchase a home and take advantage of historically low mortgage rates, or do you expect the higher rates to decrease home buyer demand and increase reasonably priced supply? I know the latter is unpredictable, but do interest rates outweigh home prices in today's market? By the way, we're going to do a mortgage bet on Kalshi for 2022. All
right, 7%. Lock it in. 7%.
No,
yes.
Mortgage rates. What are you talking about?
Oh, okay. What do you think? Saying like, will they get over
4%? Will the 30-year, I don't even, where is it today? 3? Is it under 3? I'm going to say, will the 30-year get over 3.5%? I say no.
That's tough. I think it got close to that mid-year. That's not a bad one.
Any question? Any response? So the question was, do you expect higher rates to decrease home buyer demand? I don't really think so. I think it's going to affect prices, but it's not going to affect demand because demand is one way.
I think rates would have to, especially since supply we know is not getting all that much better. I think rates would have to go noticeably higher to like 5% to really dampen demand. Like, do you think if someone's been waiting for a house price for the last 18 months to get in, that all of a sudden because rates rise, they're going to say, no, I'm out?
I think
wait for rates to fall?
No, rates are going to impact prices, which might impact supply, but I don't think it's going to impact demand.
Yeah, I don't think so either. I think that demand is like a one-way street.
Yeah, when I say supply, like if rates go up, prices come down, people might be like, I missed it. I missed the window. I'm not going to sell.
Oh, right. Yes. But yeah, it would have to be a lot. But the whole waiting to purchase a home thing, I feel like that's like waiting to buy in stocks in 2011 or something, where every year you wait, unfortunately it's gonna feel worse and worse.
Yes,
and I think that's where we're at.
This person said also, I love the show. Recommendations. Have you considered doing a top 10 recommendations from the past year to finish out 2021? No, sorry, we missed that window. But before I forget, I just would like to say thank you to everybody who listened. We've probably done 100 episodes this year.
Probably yeah. Someone else asked me that too. I thought about it, but honestly, 2020 and 2021 are so together in my brain, I wouldn't even remember what I consumed from one year to the next.
No clue. Oh, that reminds me. So yeah, just a sincere thank you to everybody that listens every week. Like, we appreciate it more than you could imagine. We're doing a special episode. I am very excited. Tomorrow, well, it should be coming out on Saturday, we're doing an episode with Howard Lindzen. We're going to talk to Howard about how the hell he got here and where is here. He's done pretty well for himself and for his investors.
He's been ahead of like every trend of the past 3 years.
Right. So we're going to talk to Howard about what he's doing next, which I think is pretty exciting. So that will be coming out on Saturday.